Well, good afternoon, ladies and gentlemen. Wow, I think we're more popular than a Justin Bieber concert today. Apparently he's in the room, but I was just looking at Jim Gerry and he's not nodding, so that's all right then. Welcome to our little talk on profit commissions, getting the best and avoiding the worst. Let me do a couple of introductions first of all. I have John Needham from PKF. John is the leader of their insurance team and has about 15 to 20 MGA clients on his CV, and a lot of practical experience in this area, as do a lot of his team. And immediately to my right is Sara Ager. Sara is a partner with us, formerly at Penn Underwriting, hands-on resolution of disputes in relation to these sort of profit commission formulas, and as a side business runs a wine business, if I may say so. So if nothing else works, guys, get your wine there, okay? Our little running order, obviously, Sara's going to do a little bit on the legal aspects and a little bit of the interpretation of contracts. I may say I see some absolutely horrendous wordings around the market, led by some of our most illustrious insurers. I'm sorry to say, guys, you don't do yourselves a bundle of favours with those. John's then going to touch on a few of the aspects relating to the accounting aspects, the horrors that come with IBNR, and I will then draw together a few of those things and we'll have a little bit of a Q&A type thing where I will put a few questions about pitfalls and all the rest of the things to avoid with regard to this. And then we'll have a general Q&A session. Somebody says they've got some horrible questions in the back already. But can I just ask one question before we start? How many of you, and be honest please, how many of you actually been involved with a dispute relating to profit commissions? Can we just have a little show of hands? Because I think it's surprising the number of people who actually have even got to the courtroom door with regard to profit commissions. It seems to be one of the biggest items on your balance sheets as MGAs, and yet the lack of clarity of wording, the lack of clarity of practice, the lack of consistency of practice around the market is in my experience, absolutely horrendous. It's just not an area that we seem to understand collectively, and that's not just MGAs, that's insurers and brokers. And the confusion often comes because the expectations of the three parties just are not pulled together. Anyway, look, I'll say no more and I'll pass over to Sara.
Hi, good afternoon everyone, and thanks so much for coming. There's lots of familiar faces. So we thought it would be quite useful to begin this afternoon just to do some scene setting, if you like, set out the basis upon which MGAs can be paid, because there's a number of ways in which we can receive our monies or payment for our services, if you like. Profit commission is only one of them. And to be honest, the other areas aren't without controversy either. So that's the basis on which I'm going to start, just by explaining how you can, as an MGA, derive income. So apologies if I'm repeating stuff you know. At the back of your pack, there are some useful pieces of information as well, which provide the background and some information on the payments and commission structures which intermediaries are led by. In particular, ICOBS 4.4 might be useful for those of you who are involved in commercial kind of placements in the MGA sector. Anyway, without further ado, I'm going to just crack on and explain how those payments can be received. I'm happy for you to interject and add questions whilst I'm going through. So I'm quite informal in my presentation style, so please do feel free to kind of put your hand up if I've not been clear on anything. So the first and easiest way in which an MGA can receive payment is under the traditional fee type arrangement. For me, this is the clearest and cleanest way we can all receive payment. Firstly, because it's agreed up front by your client. Normally is in respect of specific services, so everyone knows what they're paying for and what that looks like. And it's normally between yourself and your ultimate customer rather than the syndicate or managing agency with whom you place your business. So in that respect, it's quite a nice, tidy, neat way. As long as you can demonstrate the value for the services, then you're entitled to make that payment or claim that payment by way of fee. Commission, however, is the most usual way by which an MGA receives their income. As I've hinted at, ICOB's 4.4 is particularly pertinent to those who deal with commercial customers. Just so you're aware, there's no legal reason or regulatory reason why you need to disclose what commission you're receiving to a retail customer in any circumstance, and you only need to disclose it to a commercial customer when they ask you. So to a large extent it's down to your own integrity and remembering that your fiduciary duty as an MGA and where it lies. Once again, a commission doesn't need to, somewhat different to a fee, it doesn't need to be disclosed up front. Needs to be a reasonable amount, but most importantly there needs to be a written procedure to manage what that calculation is and how much you're charging. And when you are looking at charging a commission for the services you add, I think in this day and age and with the increased focus by the FCA, one needs to bear in mind that any commission needs to be reasonable, you need to be able to demonstrate value, and you should always look at the transaction from a customer, i.e. the person who's buying the insurance's point of view when you're justifying it, even if it does come from your ultimate carrier's underlying profit. You ultimately need to be able to demonstrate that what you're charging is reasonable. So that quickly brings me on to profit commissions. Most of you probably charge an initial placement commission and a profit commission. Now, for profit commissions, the regulation is the same. There's no requirement to disclose up front to retail customers. There is a requirement, once again, for commercial customers. But the way in which a profit commission is calculated is key and pertinent to whether or not you can recover and or you end up in the courts. To give you an idea or a framework around what a profit commission is, for me I kind of think of it as an arrangement which is conditional on the underlying profit of the arrangement you have in place with the insurer or the carrier. Unfortunately, real profit is very hard to ever calculate between one person's perspective of what is profitable and another's perspective of what is profitable, but we have to ultimately look at the profitability of the account as to whether or not the profit commission clause is triggered. There are a number of different ways in which a profit commission can be calculated. I'm not going to teach my granny to suck eggs because you all know those, but some of them I think create greater conflict between the arrangement and the partnership which is in place between yourself and the carrier. So for instance, those that are based on volume of income or volume of policies written tend to be more provocative, and I suggest that when you actually calculate what your entitlement is under the profit commission clause, you may be more open to debate and discussion and, dare I say it, dispute with your carrier. Those that are on a percentage of profitability based on loss ratio principles, then they are more certain from a carrier's point of view and from your own, but once again are subject to calculations of IBNR, IBNER, capped claims, some of the classes of business you write, if they're long tail, when does that profit commission get paid, when is the finality? But I'm not going to cross over with John because he's going to cover that in a lot more scope. The other way in which the MGA can receive income is service fees, and these are becoming increasingly apparent. Most of you are probably used to charging a document fee for the production of policy documents. Once again, I would err on the side of caution and be always thinking that the charges that you are levying in respect of document fees are reasonable, given the fact that lots of systems now automatically generate policy documents from information collation. Other charges that come in are marketing and servicing fees for the accounts. Once again, I think internally one needs to be cautious and be able to justify and have in their files evidence as to what amounts to that service or marketing fees. I increasingly are seeing back-to-back insurance and reinsurance placements whereby MGAs and syndicates are squeezing back some money there to make these accounts more profitable. So in my experience, normally all MGA businesses have a hybrid collection of all of those ways of making income. I think my overarching advice to all of you in this audience is that when you add your entitlement or your income entitlement up, it needs to be seen as fair and proportionate. Once again, always wearing the shoes of the customer, because I think you need to be able to justify when you total up commissions throughout the distribution chain that actually the benefit and the value of the premium the customer's paying represents fair value. So without further ado, I'll pass to John.
Afternoon, everybody. As David mentioned, sometimes profit commission goes wrong, and there's a number of reasons for that. I'm going to mainly focus on the accounting aspect of that and the uncertainty associated with that accounting. I think we're probably featuring or focusing on sort of some of the negative aspects of profit commission today, or the unusual quirks, and that is because our collective experiences of when these things tend to go wrong. So it's with that in mind that we're imparting our, hopefully it doesn't come across as too negative view on these things. Also, don't panic, because I'm not going to go into 20 minutes of detailed accounting on profit commission. There is, in fact, I was looking, there's a podcast from 2014 where I do that, and that's available on the MGAA website. So
It had lots of views.
It's had lots of views. There you go. So there are some secret accounting geeks out there. So 2014. I am just going to do a quick recap, though, on the kind of raw principles of accounting for profit commission. In essence, what we're, I guess, as accountants and auditors, the issue and the dispute that we have is ultimately when should a profit commission be recognised and the value that it should be recognised at. So those two key components. And generally, from an accounting point of view, it comes down to two bits. Whether the profit commission is contractually due and the value of the profit commission. So contractually due means, as it says, there is a contract in place, and under that contract I must have performed and done the service that has allowed me to collect the profit commission, and whatever guise that is, whether it's an underwriting share, whether it's a volume-related type commission. There's a contract, and if we're contractually due under that contract, that's fine. The next bit is the quantifying the value, and from an accounting point of view, we have to be able to get a reliable estimate of the value of the profit commission before we can record it in the accounts effectively. And by reliable, I'll come on to that in a second, but effectively if you've got those two bits, it's contractually due and we can reliably estimate a value, we can bring it into the accounts. And in practice, again, just to be totally clear, what we mean by that is that we can recognise it in the profit and loss account and we can recognise it in the balance sheet as an asset of the business. The recognition of the profit commission is completely independent of the cash receipt of that commission. It's a very broad statement, we'll come on to that in a minute, but the accounting is different to the cash collection. That's sort of fundamental core. So the key thing that we have a dispute over really as accountants and auditors is the value. And when we're talking about value, we're talking about the reliable estimate. So at what stage can we, as a sort of third party coming into the business, get enough evidence to have a reliable estimate of the profit commission? Ultimately, if we get a statement from the insurer which has all of the components of the profit commission calculation effectively verified by that insurer, and they have agreed that that's the amount of money they will pay, that's our kind of holy grail of certainty of profit commission calculation and certainty. Unfortunately, in most cases, that comes very shortly before the cash actually transfers over, i.e. it's settled. Quite often we're in situations where our clients wish to recognise the income earlier, so before the cash has been received, or recognise part of the profit commission, rather than waiting for the full and final settlement from the insurer. So in that process, what we're looking for is to find this reliable estimate. So we'll start looking at historic trends, we'll start looking at the large claims. In effect, we'll start behaving as if we were trying to carry out an actuarial review of primarily the claims element of the calculation. We tend to find that the other parts of the calculation, like the premium amount, like the underwriter's expenses, are relatively certain. It always comes back down to the claims estimates. So we're seeking certainty around that, which in itself is a tricky exercise. So in effect, our whole assessment revolves around this sort of search for the certainty of the ultimate claims value. And again, that causes some issues. So what is the definition of ultimate claims within the contract? Quite often we'll see MGAs presenting a calculation which has got a paid claim figure in it or an incurred claim figure in it. Actually, what we're looking for is the ultimate claims figure to really understand where that account is going to go. And then we can start to have a discussion around how much profit commission to bring in. So that's effectively our job and our considerations, looking at the valuation of profit commission. We'll come on to a load of the pitfalls of that later on. One thing I wanted to just mention was about the taxation of profit commissions, which can lead to some sort of opposing behaviours, if you like. So the taxation of profit commission will come in when the profit commission is recognised. So again, separate to the cash receipt. If we book an element of profit commission in the accounts, it will be booked in the year of recognition, and the MGA would be taxed in the year of recognition. So, cutting a long story short, you may have a tax bill to pay on profit commission that you haven't yet received. And I'm sure it will be of no surprise that many MGAs try to leave their profit commission recognition until they've received the cash. You'll find that surprising. So that starts to cause a dispute in itself, because we've got on one hand potentially a profit commission that's due, and potentially the MGA doesn't want to recognise it because there's a cash tax bill to pay on that profit commission. Obviously depends on the delay, and up to which we're going to get the actual physical cash. So a couple of other sort of unusual aspects to profit commissions, or different types of commissions, as Sarah mentioned earlier. We quite often see marketing advances or deposits, whereby an MGA will receive a lump sum for effectively a marketing purpose, or it will be an advance of commission, for example, to fund an acquisition or fund a team. To us, we see that as an alternative form of commission. So again, just to be clear on the accounting recognition of that, if you've received a cash advance, from our perspective, there's quite often a service that's associated with that advance. So we would expect the income recognition of that to happen as that service is actually provided. And again, quite often we end up having a dispute, if you like, around, or a discussion, healthy discussion, as to whether the service is actually being provided. And there are quite a lot of contracts out there in the market which on the face of it will have a kind of non-recourse element to it. So for example, me as an insurer, I would lend in effect the MGA, or give the MGA a cash advance. That would be split contractually between a marketing advance and, for example, some funds to do an advance of commission to allow that MGA to do an acquisition or a purchase of a team. So you've got the two bits, the marketing element and the advance. Quite often the wording in the kind of body, if you like, on the marketing aspect would look as though it was a non-recourse deal, i.e. under no circumstances does it have to be repaid. Quite often when you get to the detail around it, there is a recourse element to it. So we end up again in a discussion around, should we recognise this all? Should we defer it over the next 2 years, 12 months, 36 months, depending on the course of business? In respect of the commission advance, effectively, again, we'd always say, well, you would recognise that as you generate your commission. So if you add those two bits together, the marketing advance with recourse and the advance of commission, you would actually recognise none of that cash advance on day one, and it would be released over time, or brought into the P&L over time and the asset recognised over time. Again, it causes a dilemma. Quite often, when these advances and these structures are put in place, the firm is looking to grow, it's looking to acquire. If you can't recognise that amount on day one, it causes an impact on your capital calculation, which we'll come on to in a minute. One other kind of heated topic area, I suppose, is in relation to deposit commissions. So this would be a scenario where the MGA would get a base commission of, let's say, 10%, and that would be kept paid in cash as a deposit commission, just in the normal course of business. That commission is then subject to underwriting performance. So if underwriting goes well, there's a 5% upside. If things don't go so well, there's a 5% downside. Now, quite often, the performance element of those deposit commissions get forgot about in the early days, as we're working on a paid claims or an incurred claims rather than an ultimate claim. And quite often what we see is actually that 10% gets spent in the operation of the MGA. And as the claims start to deteriorate on that book of business, the base commission rate falls from 10 to 9, etc., down to the lower level. And then ultimately we're in a position whereby we actually have to pay back the difference between the 10 and the 5 back to the insurer, which can cause massive cash flow issues, certainly in our experience of those circumstances. The key thing there is, again, I'm giving you our experience as the auditor of that situation, is that where we see those contracts, we would ultimately be looking to assess the loss ratio and the performance of those contracts from effectively the first year. If we start to see signs that the book is not performing, we would look to recognise the reduction in income in the period when it starts to not perform. And there's less certainty around that area in the market. So just moving on to the interaction with TC4, obviously as you recognise profit commission as an asset, it goes onto your balance sheet. The net assets less intangibles in generality is your FCA capital resource. So bringing in your PC helps out with that capital resource. Not recognising it, it doesn't. One thing that is quite interesting for early stage startups, startup MGAs taking a profit commission, is that it's going to be some time before they can recognise that profit commission. So in the early life cycle of an MGA, actually you're having to build extra capital or put extra capital into the business to subsidise your structure using a profit commission. It's fine once you've got going because you've received one and it boosts up the capital, but in the early days you're subsidising. On the converse side, actually having a profit commission as a larger MGA adds some volatility to the income, to the business. If you've got particularly spiky profit commissions, you're starting to get into an area, let's say if you're dealing with an investor or you're dealing with a bank, they'd start to look at the volatility and say, well, actually, we can't take all of that profit commission into account anyway, even if you have recognised it, because of its inherent volatility. So we've got this kind of interesting dynamic building where smaller MGAs are effectively having to add in capital to support PC structures. You've got mid-tier size MGAs effectively doing well out of them generally, otherwise they wouldn't be in place. And then at the larger MGA side, where we're seeing firms looking for funding or looking at private equity, actually they're starting to seek to reduce their reliance relative to their other income sources on PC, purely to get to a point where the income and the profit level and the cash flow has more certainty, and it's more able then for a bank to lend to that business, where you can demonstrate that stability. So just going to end on these bits with sort of what I thought would be some just practical tools for an MGA to help them. Well, maybe to help their accountants and auditors rather than to help them. So whether that's real help, I'm not sure. So have a register of your contracts that are exposed to any kind of profit commission arrangement. So we would come into the firm and try and audit these profit commission arrangements. Generally, what is presented to us is the profit commissions that are just about to become due or have been received in the year, and generally there are way more than that. So we like to get an understanding of what's really there. So if you create a register of all contracts with PCs, it really helps to understand what's happened, what the history looks like, what the future may look like. We can get a much better handle on it. Have a clear responsibility and set of procedures for your underwriting teams to tell your finance function or the board about all profit commission arrangements that are in place. So unless you have specific functionality on your system to capture profit commission arrangements, sometimes they just appear out of nowhere, which can be slightly disconcerting, especially if it's a clawback. Have very clear calculation pro formas, so everybody understands exactly what your internal calculations look like, and then you can put all of your profit commission calculations on different binders onto the same format to be able to compare. That's also very helpful to present them all in one place for external parties. Again, we'll come on to this a bit more in the pitfalls, but I think having access to claims data is obviously part of the reason for being an MGA. But actually quite often when we come and talk to people and have this discussion around the reliable estimate, the underlying claims data of the portfolio isn't there. So we can't produce a claims triangle, for example, or we can't look at historic years. We've just got a point figure for the ultimate claims or the incurred claims at that point in time. So generally, claims data is pretty poor. We'll come on to that more. Probably critically, and this is maybe one more for the accountants, is to have a very clear policy on recognition. So when are we actually going to try and recognise this profit commission? So as a rule of thumb, and again in our podcast, I'll let you go back and look at that, we would say that for short tail business, say in the Lloyd's market, you don't have to wait 3 years to understand what's going on with that book. If you've written it for a number of years, you'll know at 18 months, 24 months where that book is heading. And actually at that point, you could recognise that in your financial statements. So quite often, again, going back to that cash point, we find firms not wanting to bring in the PC. And we're saying, well, actually, you know, if you handed it over, I'd give you a figure for roughly how that's going to work out based on history. I'm not an actuary, so I probably shouldn't say that. But there's, again, this dilemma. But just coming back to the point, if you have a very clear internal policy on when you're going to recognise things, it makes it much clearer to all your different teams about how you're going to do it, and it makes it much clearer to the outside world, to the lenders or to your accountants. This is what we do with profit commission. And finally, just on those tips, just have an early engagement with your accountants. So I had a really unusual commission arrangement the other day, which was a continuity clause type arrangement. I was sent the contract by the client before they'd actually signed it to say, how would you recognise this in the books? So rather than having a sort of dispute around it 12 months, 24 months later on, let's just talk about it and agree it up front. So they're my tips for avoiding disputes, but we'll talk about some more in a minute.
Thank you, John. One thing that John didn't pick up on, but you might like to bear in mind, is that HMRC are currently reviewing all commissions and all fees in the insurance sector as to whether they're VATable or not. This follows on for the Aspiro decision in Poland about 9 months ago. It was supposed to be coming out before we had the Brexit referendum. Nothing's come out yet. We'll still be part of Europe, and the relevant legislation will come through Europe. So just watch this space, because pretty well any commissions could be up for grabs for VAT. And I know that sounds of, oh, we can't do that, but if you remember, the exemption is making arrangements. And it could be argued that a profit commission is not relating to the making of arrangements, it's just a sharing of the follow the fortunes of the actual insurers. So watch this space about profit commissions and contingent commissions, because I heard that whisper last week, which is a little bit annoying, let's put it that way, to say the least. And the other thing, of course, to bear in mind, and it's one of the things that we've asked the FCA, I don't know if some of you were in the room, I know we're here with a presentation with the FCA. Come the glorious day when commissions right across the book are going to have to be disclosed to the ultimate consumer, what are we as MGAs going to have to disclose? Yeah, now, we think as the MGAA that probably 10% of the MGA's book of business, that's about 350 million, is written directly to consumers. The rest of it is all wholesale through brokers, if you want to call it wholesaling, but wholesale pass-through brokers. Well, who are we disclosing to? Because we're not going to disclose a profit commission to our insurers, and that's just nonsense. So what are we actually going to disclose and to whom? And that's one of the questions that we posed to the FCA. And I say we have absolutely no clarity on that, because I don't think they've got any clarity yet about what's going to happen come the day when we actually have to disclose commissions. And for those of you who think that's rather controversial that we'll have to disclose commissions, that's been coming for about 20 years and it's now in the IDD. So let's see how the UK government bring that into our legislation. Okay, now I'm just going to ask a couple of questions of my good colleagues here on the stage about mistakes and pitfalls. So, John, what are the major problems that you see? What's the major pitfalls that you see when at the point of formation of the contract? What do people tend to forget when they're negotiating the contract?
So I guess I'm going to carry on with my accounting experience of this.
Of course.
Naturally. The one thing, again, just sort of coming to the disputes, is just comes because of lack of certainty this time around actually how a calculation is calculated, how it is produced, what is physically going to come over as a bit of paper from the insurer saying this is the profit commission we're going to pay you. And that sounds really simple, but it's probably looking at one a couple of weeks ago where we actually had the binding authority agreement and the profit commission page, everything was signed, and the profit commission said TBC. So they were like, oh yeah, well, we're in the process of sorting that out, and this was 6 months into the contract. And of course, at that stage, it was a new contract, new underwriter. At that stage, the underwriter's got 6 months' worth of claims experience, and they still haven't agreed the profit commission calculation. So you can see what's going to happen there, depending on what's happening to the claims. Now, either way, it's going to end up not where it intended to be started, unless you're incredibly lucky. So, cutting to what is the issue is just really making sure that you've got absolute clarity around the profit commission calculation in the contract before it's signed. To the extent of most, I would say, have worked examples, but they'll use X's and Y's and A's and B's rather than real numbers. We quite often see disputes over the definition of, I'll be silly because I'll end up getting a technical mistake here, but let's say the definition of ultimate claims or the definition of ultimate premium. The MGA and the insurer will take a different view as to what's included within that, and that leads to uncertainty. So actually, if you can have a not only the maths of the calculation, but real figures in there related to the original business plan, to say, okay, well, if the business plan, if the binding authority works through based on the business plan, this is the exact profit commission that you will get. That's great, because then everybody can have a bit of certainty.
So a worked example with every agreement, John. Yes?
Simple as that.
And just taking the numbers thought. So presumably if you're producing a business plan, the business plan will have an IBNR figure and an IBNR calculation. How much detail would you like to see on that IBNR calculation? My only concern is that I see business plans and I see an IBNR number. Okay? And then I get down to the profit commission dispute at the end of the day, and they've calculated the IBNR on a completely different basis. And then the next year it's calculated again on a completely different basis. So how do you ensure that there's any consistency between the IBNR calculation on your example, for instance, on the negotiation, and the IBNR that comes up 3 years down the line when somebody's calculating it? Do you see any consistency across what's happening?
Yeah, I think that goes straight to it in terms of having that clarity on day one around the basis of calculation. So in the business plan, if we've got a planned loss ratio and that's been through the actuarial review within the carrier, there must have been some assumptions used around the calculation of the reserves, the calculation of how it's all going to run out. Those assumptions are still valid at any point, during the life of the contract. So the more understanding you can get around the original assumptions and how those would apply to the profit commission calculation in the future gives you more certainty around, or more understanding, and therefore more ability to be able to accept the calculation as presented. And I suppose part of this comes down to sometimes the lack of transparency from the underwriters around exactly how they've come up with the figures that they've come up with.
So the number one pitfall, failure to nail down what IBNR really means and how it's calculated. So Sara, I've seen some truly horrendous profit commission wordings when I've come across, and I may say they're one of the very big beasts in the market. I was negotiating it with them, actually for them, would you believe, and I said, this just doesn't make any sense to me. And they said, and I said, I'd like to tidy it up and change it, and they turned around to me and said, no, we know it doesn't make any sense, but that's what we like. And you're thinking, yeah, and I said, but how many binders have you got out in the market? Well, we've got about 26, 27 out there, covering about 150 million, but we really like the uncertainty. So you get it. So, Sara, biggest problems contractual-wise of negotiating these things?
Well, I think I'd echo what John says. The clarity is in the detail, so it's knowing what you're signing up to, actually. So it's having the right words and the right definitions. Clarifying, when's the profit commission going to be calculated, by whom, whose numbers are you going to rely on, when's it going to be paid, by whom, to whom. Are we using IBNR? What happens about IB and ER? Whose valuation of IB and ER is it? What are the underwriting expenses? How do we understand how much is being charged by our carriers in respect of underwriting expenses? Is that a reasonable sum? Is there any way to negotiate that down? Can they demonstrate why they're charging that? For instance, what about large losses? Can we cap them? Are we being charged for their reinsurance program that they get benefit from and we don't? All these kind of questions. If we can have a transparent conversation up front with our carriers before we enter into the agreement, the binding authority, before any bad losses have come in, I suggest are much easier than when maybe a loss has come in and is already on their desk. So I think agreeing up front, as John said, is key. Just keeping each other apprised of what's happening. I always drone on about it being a partnership between you and your carrier. I think profit commissions are a case in point. Appetites need to be set as to whether or not a profit commission is going to be triggered. If it's not, and the MGA is struggling, then maybe it's a case of going back to renegotiate the base commission. There are all manner of ways, but if you keep that dialogue open, I think ultimately it makes these things easier to resolve.
Yes, I must say that looking at some of the wordings, there seems to be a huge amount of, I think John's phrase, so I won't take a phrase away from him, but we were discussing it earlier, there's a huge amount of over-optimism amongst the MGA market. We're all optimistic that everything will work right, that we're all very optimistic that we'll all make a profit. I think the point is actually some of the wordings, we'll make a profit commission of 7.5% of the overall profit. I've seen wordings as short as that in binders. And you're thinking, what? What does that mean? And the point is, we're optimistic that we'll just work it out later. And that's when you've got the difficulty, and that's where you have a lack of certainty as well. I may say that that particular wording was probably void for uncertainty as a matter of legal construction. Anyway, so, okay, well, we've talked about the ones up front. So, Sara, what do you consider the biggest mistakes are when you're negotiating the PC? Actually getting down to the nuts and bolts, sitting across from your insurer and saying, oi, I want my money.
When you're negotiating up front?
Well, negotiating the actual numbers. What do you think the biggest mistakes are there?
Well, I think the claims position, obviously, is key. So if you don't have transparency of claims data, then that immediately creates an inequality of power around the negotiating table. If you provide claim services, then obviously that makes it somewhat easier. But I would be looking in my delegated authority agreements to have provision whereby my carrier needs to give me, as a matter of course, the MI in relation to the claims if I'm not dealing with them myself. So there needs to be a reciprocity of data and information between the parties to that arrangement. After all, it is a partnership, right? You're all in it together and you all want to make profit. So how can you double get and manage a portfolio if you don't know how the claims experience is progressing? So I'd be looking for that kind of information. I would, as an MGA business, be as transparent as possible with my own costing, show them what my expenses are, and I'd also seek to justify the value that my business offers to increase my own commission, upfront commission, but also to justify reduction of their own underwriting expenses. Effectively, more often than not in the larger organisations, my experience is that that underwriting expenses are a percentage charge levied across all areas of the business, and there's not necessarily a deduction in the delegated authority section because obviously it's seen as a central charge. So as an MGA business, if you can demonstrate that you provide greater services, i.e. than the provision of MI, then you take away the need for that central unit to take costs from their central cover. So a big composite will basically have underwriting expenses which they share equally, say at 10%. If you can demonstrate that your MI no longer requires them to rely on the MI pool that they're getting centrally, then obviously you need to show them and ask them to go back and explain to their central services why their cost base should be 9% rather than 10%. Now, I know it's not an easy conversation, but the more advanced you are and the more upfront about explaining what services and value add you make, then I think you're in a stronger negotiating position.
John, do you want to add anything to that, or is your beef still mainly about the IBNR calculation?
I have many facets, David, so I'll move on from that. Actually, I kind of move on. Just what you were saying earlier about the over-optimism of the market can actually have some unintended consequences. So linking that back through to the negotiation, actually it's worth playing through a number of different scenarios midway through that negotiation, if you like, in terms of the financial consequences of the profit commission versus the base commission that you have. So, for example, if we're sort of starting off from a point of the MGA is going to be optimistic about performance, we've kind of automatically got to fight against that and say, right, okay, what are the what-if scenarios if it all goes wrong, and model that through. So again, we've had a few clients who've been really badly burnt by deficit clauses, and burnt in a couple of ways. So obviously having a deficit clause in the contract is less interesting if you're coming at it from an optimistic point of view, where you think, well, it doesn't matter that it's there because it'll never kick in. Actually, if we have a huge loss one year, it could then wipe out our profit commission for the next 2 or 3 years. So that's bad news on one hand because we haven't got a profit commission, but then the other sort of unexpected consequences, you usually have a dispute with the insurer because you're kind of being under-remunerated for your actual work that you're doing, because you originally anticipated getting a profit commission every year. So quite often what we see is, if there's a big spike loss in 1 year that hasn't got a reinsurance cap, as Sarah mentioned, invariably a year or 2 years later, the MGA seeks to change markets to reset the profit commission calculation again, or change markets to renegotiate a contract. So you have these two negative impacts. One is the lack of profit commission. Two is a change in market, which actually, you tend to find that people had wished they'd negotiated the contract slightly differently. So I guess just going back to the original concept of the modelling, why not just model through your own numbers, one based on how you expect it, one based on the spike loss, but making sure you take into account any deficit clause and things like that. Maybe actually your negotiation then tends to be around capping the deficit clause or capping the maximum loss. So again, coming back to this point of stability of income, because if you're really at risk of losing a big chunk of your income, you may well be better off with a higher base commission, even if it is a much smaller fraction of the profit commission.
Just coming back to this whole question about the calculation of the PC. I'm not sure. I've not seen this, but it is something I'm just sort of throwing out to everybody. Insurers, in my experience, are always incredibly reserved in setting their IBNR calculation. They always overestimate it. That's what they do, particularly after Solvency II. They've got a little bit better about it, but they still overstate it. So, has anybody seen, John, has anybody seen a scenario where the profit commission is recalculated for a year, say for 2 years further on when the IBNRs develop? I mean, I was talking to a couple of my colleagues at the back earlier on, and we mentioned briefly the point that most IBNR calculations, most tails develop within, say, 2 to 3 years. All right, there are liability accounts where it takes longer, I agree, but why can't we recalculate the profit calculation twice or 3 times for an individual year? Surely it's just a set of numbers that becomes more and more certain as that period goes on. Profit commission disputes disappear. Has anybody seen anybody doing that? I'm just surprised that I haven't personally seen that, but I just wonder why it hasn't happened. Too much work? I don't believe that nowadays. There's so much MI that comes out of these insurance companies, in fact out of underwriting agents now. You're all on better systems than you were 10 years ago. Why can't that occur? Have you seen that, John? Sorry? No? Well, there you are. I've thrown out an idea for your next profit calculation, PC calculation. I'm just going to touch on a few bits and pieces now as to why all this matters. It sort of falls down to me. At the end of the day, profit commissions, a lot of people in the room actually put a lot of stall on profit commissions. Profit commissions, we talked about when they're earned and when they get cash. Cash is what it matters. If you don't know what your profit commission is, how can you plan what your earnings are going to be? And that comes down to a further discussion in a second about earnings, and ultimately what your cash flow is. And if you haven't got cash and you have to repay some because there's a deficit clause, you go tapping on the bank's door and they say, why did you get it wrong? Well, we didn't get it wrong, it's just the way it went, guys. But it's cash at the end of the day. So all I'm saying is the more certainty you have about your earnings and your cash flow. And people tend to forget that in all walks of business. So we've seen plenty of people who've overspent profit commissions and then not received them. And of course, if you don't make a profit on your account, your business is going to get cut. I'm afraid there are very few underwriters nowadays who are allowed by their betters and seniors to write accounts in perpetuity to loss. Yes, you'll get a few, but then, Gable was inevitably going to happen, in my view. But there are not many around the market who will run an account that's going to make a loss year in, year out. It just doesn't happen. So, at the end of the day, it comes back to my 3-year projection. Why can't we actually have profit commissions calculated over 3 years? We need certainty. I've done a lot of M&A transactions in the broking MGA sector. What buyers want is they are valuing, everybody is valuing by EBITDA, and if you'd like to know, we think that brokers are going for 8 to 9 and MGAs are going for 9 to 10 times multiples of EBIT. But EBIT is recurring income. PCs are not recurring income. So if you don't have certainty about those, any buyer is going to discount those and come up with some other weird and wonderful way of valuing your profit commissions. Well, hang on, you can't discount the profit commissions. They could be a big number in your profit and loss going forward. So how are those going to get valued? When are those going to get taken into account? When are you as sellers going to get paid for them? Because you should get paid for them. I should add that the other thing about that is that if you've got an uncertainty, you postpone it, and actually it also postpones the capital gains tax liability, which might actually have an advantage. Underwriter bonuses. Profit commissions are paid on a 3-yearly account. You'd be amazed how many MGAs and insurers actually pay profit commission bonuses to their underwriters on an annualised basis and do not wait for the account to come through in 3 years' time. So when John was saying, well, can you estimate it going up front? Sorry, many of you are actually paying annual bonuses to your underwriters on what you expect the account will be, even though you've got no real idea how that account's going to develop and whether you actually, as a firm, are actually going to get a profit commission later. That disparity between the two just strikes me as just gobsmacking, because you pay a lot of money, plus 14% national insurance to your employee underwriters, and yet you don't know you're going to get a profit commission. That just astounds me, that disparity, but it occurs right across the industry. I don't think I've ever seen anybody that has picked that up yet. And the last one is, well, go to your bank. I think there's a couple of bankers I saw earlier in the room. Well, when you go to your bank and you want to borrow a little bit of cash to do, a bit of investment or new systems or doing acquisitions, they'll look at the profit commissions, and if you don't have a handle on them, they're not going to go into your earnings ratio on the bank debt. Well, I'm sorry, if it's a big part of your income, you're going to suffer. So those are just things that you just need to be careful of. I'll say no more about these little bits and pieces. These are just throwaway bits on the profit commissions. All I say is that I've seen so many people draft these in so many bad ways, and I have so many little arguments, and I do think that insurers are skinning you in many cases because they have the whip and an IBNR. So, it's not trying to put the insurers down. They have a job to do, and they have a job to make a profit for their shareholders. But it's a case of, information is key. Right, we have a couple of microphones in the room. Peter's got one. That's Peter, by the way, if you haven't met Peter before. And Jane has one here. So if you've got any questions of our panellists, you can throw them at them. I'm very happy not to take any more questions. Thank you. There you go. Questions? Anybody got a question? There must be one or two. Mike.
Hi there. As you say, IBNR is always an issue for the market. Is there anything that the MGA can do to provide guidelines for us that would say IBNR for certain classes would be within a range? Be quite an interesting thing for us all to understand.
I'm not sure that's one I can particularly answer, actually. I mean, the problem with IBNR is it's set by class, isn't it?
And by
how many
insurer.
classes of business do we have? Yeah.
And the difficulty, I think, is it's set by insurer and by class, so it's almost impossible to do that. I think a much more certain way would be to try and, as I've hinted at, agree what large losses will be capped at, because then there is some certainty and finality. So it doesn't, the impact on the larger losses for IBNR purposes, which is the ones actually most people put money on to make provision for, it takes away that uncertainty if you agree what it should be that capped at $500,000, $1 million, whatever you agree with your insurer, and depending on your class. I think it's much safer to look at it that way rather than try and agree how and why, and if we could have a central IBNR definition. I think for me that would be quite hard. I don't know, what do you think, John?
Yeah, I think certainly what we're starting to see, and it crosses into this, is that some of the larger MGAs in the market are starting to bring in actuarial capability. So they're not, this is both on the pricing side and on the reserving side. So they're actually then able to start if they're much closer to the claims, they can start to build up their own picture of exactly how the book's performing. I guess from my experience of the limited sort of reserving involvement that I've had as an auditor, the closer you can get to the claims data, the actual actuarial methodology that would be applied on a sort of short tail account, it isn't absolute rocket science. So if the underwriter is prepared to share with you their methodology, it's definitely within the capability of most firms to come up with, not necessarily to second guess things, but to be able to better understand how the gap, if you like, how the IBNR figure comes about. And I think there are a fair number of sources of data out there on ABI stats and things like that on typical classes. I guess it becomes more problematic where your portfolio or your binder is running not the same as the market average, and then you end up with a tendency, if it's running better than market average, you'll end up with a loss ratio nearer to the market average in terms of the insurer.
And also I think there's a question there about using data for the market, because lots of you guys all do niche businesses, so arguably the data that's available to the wider market isn't necessarily relevant to your portfolio. So I also think, having your own actuaries does resolve it, but only if you've agreed up front on whose basis the IBNR is forecast. And my experience is that insurers don't really want to give over that ownership of IBNR numbers to the MGA, who would maybe, dare I say it, to look more positively at a large claim than their insurer partner. I don't know. I mean, they're all suggestions. I don't think there's any one rule or science here. It's you need to find out what works with you and your class and your book, I would suggest.
I think if it's in the spirit of a partnership, what is wrong with the insurer talking to you about how it's going to IBNR reserve, how the reinsurance is going to work? What's to stop you going out and trying to buy, not quite a stop loss, but the sort of stop loss on those very large claims on your own portfolio and insuring that? There is a financial risk there. That is an insurable risk. You could go and do it. I don't think anybody's ever done it. But the insurer's already doing that on the reinsurance book. So
I would suggest
why can't you go and do that? That spirit of partnership should be there. Why not?
And I would suggest you're already paying in part of their reinsurance programme and their underwriting expenses anyhow, so that might be somewhere you have some leverage to discuss.
Any more questions, James?
John, you mentioned this, but it's sort of a consistent theme where it seems that the challenge arises when the company, the MGA, wants to recognize PC before it's actually paid. But could you speak to kind of the flip side of that? Will there be a situation where the taxman is placing pressure on the MGA to recognize some PC is earned for tax reasons, recognizing that before it's actually been received? And I guess the point being, does the MGA then have an obligation, do you know what I mean, to recognize some of that as earned?
We're going deep on the tax and accounting. So in theory, the income recognition will follow UK accounting standards, and the taxation of the profit commission would follow the then recognition under the accounting standards of that profit commission. So if HMRC is effectively saying you are not recognising your profit commission in accordance with UK accounting standards, then they can have effectively some kind of recourse to the firm, effectively. In terms of their understanding of it, in our experience, there is pressure once it's understood, but it's quite rare for an individual tax office effectively to pick up on that as a specific issue.
Any others?
Sorry, just to comment on the question you had around quarterly analysis of your PC from an IBNR perspective. My experience in the past is that a lot of chief actuaries want to smooth the underwriting profit. So what you find is, even though they undertake quarterly reserves, if performance is better than expected, they'll tend to hold on to reserves. And so if you were to look at the releases between quarters and then the year end, you find that at the year end there's a lot more volatility than during quarterly reserves. So that one will always be a bit tricky because of the way the insurers themselves would reserve. If performance is better, they'll try not to have volatility as well within the underwriting profit. So in my past, when I was doing any reserving exercises, I always found that even if performance was better, a commercial decision will be taken to hold on to a bit of the reserves and not to release them until the year end.
And that's why I suggested that if you were to be smoothing it over the profit commission over 3 years, so that you've actually got a true development of the IBNR, then actually you get a true profit commission and you'd have fewer disputes. My concern about it is if you were to go around the room, and some of you I know are very successful MJs, but the vast majority of the folk in here, I suspect, get a profit commission from most of their people that's maybe less than a 7-figure number. Now, I'll tell you, you go to a bunch of lawyers and they'll fight about a 7-figure number. So let's start talking about a legal bill as sort of going up for about $250,000. And then suddenly your profit commission becomes a much less attractive thing altogether. So all I'm saying is to remove uncertainty, better wordings, better resolution of the IBNR, better clarity on expenses, perhaps smoothing to remove that sort of thing. I'm just trying to look for things that actually avoid the £250,000 legal bill that you get if you get a big punch up and go all the way to the High Court, because that's just not where anybody wants to go.
And I would add to David, it's not just about the lawyers' bills, it's about all the management time and effort that's wasted quite often in calculating these profit commissions internally. Actually, the amount of time everyone expends outweighs any value, so that's why I think clarity up front is key.
No, it's a good point, though. I get why they do it, but all I'm saying is, well, look, we would never see that any corporate or other commercial transaction where you just have a one-off hit and hope, because that's effectively what you're doing with an IBNR. IBNR could be vastly underestimated, could be vastly overestimated, but my experience has never been that I've never seen an underwriter who's underestimated their IBNR by a huge amount, deliberately. And that's all I'm saying to everybody is that why can't we just do it in a slightly better way? I'm not saying my way's better.
Can I ask you a
just
question,
a suggestion.
maybe?
Yeah.
I'm not sure if it's supposed to go this way. So in your experience, do you think it would help level out if the MGA at least kept in track on a quarterly basis to look at these figures? Is that something that you would recommend?
I would agree with that because
Okay.
I think I would support what you said, which is if you don't have that data, the claims data, and if you don't have someone to challenge what the carriers are doing, then you always have the short end of the straw. So essentially it helps to have either some actuarial expertise, or I'll probably put it the way you put it, which is if you do have the claims data, it shouldn't be too tricky to find out what a reasonable IBNR should be. 10 actuaries will come with different final figures, but essentially the final figures should be within a reasonable range if they're using a reasonable method. So I think, definitely focus on data is always good, and what we do is we do track the performance, the ultimate performance regularly. That way, if anything is happening, we can quantify it. And I suppose from an MGA perspective, if you start seeing at a quarterly reserving exercise that your performance is tracking outwards, then you don't have to wait to the year end to suddenly realize all these big movements in your profit commission, because you can address it early as well.
Thank you for that. That's helpful.
Are there any other questions? Well, just to wrap up, guys, and actually taking the fine comments there, look, certainty is everything in this sort of thing. IBNR is obviously fundamental. Avoid surprises. And I think actually quarterly reviews and that sort of thing on your claims data is probably not a bad thing to have in any case. And let's just try and do it a little bit better going forward. Anyway, thank you very much to my panelists, to John and Sarah, and thank you all very much for coming along.
David.
Sorry, thank you. Just before everybody runs off, we're back here again on the 28th with Ambent, looking at InsurTech, hype or game changer.